Gold just touched a fresh all-time high, while the KLCI quietly slid to a multi-month low on the same day, and almost nobody in Malaysia is connecting these two dots. If you are holding ringgit-denominated assets right now, you need to hear this. We are living through one of the most aggressive safe haven rotations in recent memory, and Malaysian portfolios are sitting in the blast radius. Let me explain why. Global capital is flowing out of risk assets and into gold because central banks, sovereign wealth funds, and even retail traders are pricing in three uncomfortable realities. 1. Sticky inflation in the United States is delaying rate cuts. 2. Geopolitical tension across the Middle East and the South China Sea is refusing to cool. 3. Currency debasement fears are spreading from emerging markets into developed ones. That cocktail is rocket fuel for XAU. Now bring it home. The KLCI is heavily weighted toward banks, plantations, and utilities. When risk-off mode kicks in, foreign funds dump these large caps first because they are the most liquid exits. Add in a ringgit that keeps drifting weaker against the dollar, and overseas investors lose money twice, once on the share price and once on the currency. That is why the index can crash, even when local fundamentals look fine. Palm oil is another hidden trap. Yes, CPO prices have been firm, but the sector is tied to China demand and biodiesel mandates that can shift overnight. If global growth disappoints, palm oil exposure inside the KLCI gets repriced fast, and your dividend stocks suddenly start behaving like cyclicals. So what do you actually do? First, check how concentrated your portfolio is in Malaysian banks and plantations. If it is more than half, you are not diversified, you are exposed. Second, consider a small allocation to physical gold or a gold-backed ETF as a ringgit hedge. Even 5 to 10% can dramatically reduce drawdown during currency stress. Third, watch the USD-MYR pair like a hawk. When it breaks key resistance, foreign outflows usually accelerate within days, not weeks. And finally, stop assuming the KLCI is safe just because it has been boring for years. Boring indexes crash too, especially when the currency underneath them is weakening. Volatility in 2026 is not a question of if, it is a question of when. The investors who survive are the ones who position before the storm, not during it. If this helped you see the market differently, hit subscribe right now so you do not miss tomorrow's breakdown on the exact ringgit levels that could trigger the next leg down.